Hello, I would like to talk with you about a fundamental choice facing everyone concerned about their personal wealth management. Should I invest in stocks or bonds? But first things first, I'm assuming this is money you can afford to put at risk, not the money to pay the rent. I'm assuming you're a regular saver. You're living within your means, saving every month. I'm assuming you're interested in your long-term wealth management strategy, not a get-rich-quick scheme. And I'm assuming you're busy earning a living and you're happy to invest in a professionally managed mutual fund for bond or stocks. Now, a mutual fund will give you a well-diversified portfolio that will give you the lowest risk for the best return. So, what's a bond? Well, if you buy a bond, that's equivalent to lending the money to a company or the government that issued it. Whereas if you buy shares of stock, that means you're actually buying ownership in a company. But here's the first rule. You don't get better returns without taking on more risk. And risk means the chance of making money or losing money and the degree to which you might make or lose that money. Bonds have lower risk than stocks because, by law, a company has to pay all the interest to all the bondholders before it can pay any dividends to the shareholders. So that makes interest payments very steady over time, whereas dividends and profits for the shareholders will probably vary, which means the stock price will vary, which means owning stocks ain't for sissies. Okay, let's look at some graphs to illustrate these differences. I'm using what we call index funds because they mimic the average performance in the markets. For the stock market, I'm using the Standard & Poor's 500 index. For the bond market, I'm using Barclays U.S. Corporate Investment Grade Bond Fund. The first graph shows the annual performance of stocks and bonds for the period 1976 to 2012. That's 37 years. Notice the large upswings and downswings for stocks, particularly that dive the stock market took in 2008 as the credit crisis became evident. People lost 37% of their wealth that was invested in stocks during that single year, 2008. I remember that feeling, and that was not a good feeling. Bonds, on the other hand, were also not completely steady, but they were steadier than equities. So to illustrate that, I have a table that shows the odds of losing money in any year. That was 14% for bonds, 5 years of losses, 19% for stocks, 7 years of losses. But more importantly was the average loss per year that when they did lose money. And that was much lower for bonds. For those 5 years that they lost money, it was only 2.6%, whereas it was minus 13.6% for stocks in the years that they lost money. So what's the upside? Well, the upside was better for stocks. When returns were positive, they averaged 18.5% for stocks, but only 10.9% for bonds. Now, the average for all 37 years was 12.4% for stocks and 9% for bonds. All this to say that on average, stocks have a higher risk and a higher expected return than bonds, which is why we have this old adage that investors must choose to either sleep well, that's investing in bonds, or eat well, that's investing in stocks. The next graph computes how much money you would have earned over these 37 years by investing either $1 in bonds or $1 in stocks. Right at the beginning, January 1st, 1976. The assumption is that you're also going to reinvest all the interest or the dividends received along the way, all 37 years. Well, the difference is dramatic. That $1 investment in the bond fund would have grown to $22, but stocks would have risen to $48. This last graph assumes that you were able to save and invest exactly $500 per year. Now listen, that's only $42 per month. Over the 37 years, that's going to add up to $18,500 of total investment. If you invested those every year into stocks, you would have accumulated a total of $206,000. If you'd have done that for bonds, you would have accumulated $125,000. So this steady investment over the long term is the real key to financial success. So I know what you're thinking. Hey, thanks a lot, Professor Eades. But I really like my sleep, and I also like the idea of eating well, so what should I do, bonds or stocks? Well, most wealth management professionals will tell you to split your money between bonds and stocks. Maybe a 50-50 split would be a good starting place. You can't escape the risk of investing, but you can manage it. And by taking a long-term view, you can gradually move towards your goal of financial well-being.
you.